Welcome to the Dividend Talk podcast, episode 270. 3 safe dividends from the Nordics. Hey, European DJ. Another jam-packed episode we have today.
Oh, yes, definitely. But, it's been a busy week, so I was actually looking forward to this. I don't know how it's for you, but it's so busy at work that I don't really have time to follow the stock market this week very closely. So for me, the weekend is actually jam-packed with all the updates that I need to do. Also, we are releasing the next newsletter this weekend, which is about Cibus Nordic real estate. So there's a lot about the Nordics today here, right? We really wanted to talk a little bit more about this stuff here.
Yeah, of course. I mean, we've been speaking about Malmo, our meetup in Malmo, for a few weeks now, which is really starting to ramp up. It's not too much longer now we get to meet up, but we have an active group at the moment. We're in the planning phase. You sent out an agenda, so some really good characters there, and I can't wait to meet everyone. It's going to be awesome. But since we talk about Malmo and Sweden so often, we thought, why not talk a little bit about Nordic companies, because there's lots of, and we know this from our community, right? There's lots of really good companies in the Nordics. Hey, but that's not all we will be talking about today. We also talk about Merck. They have an acquisition that they are planning in Q1 2026. We're talking about Siemens, who had their earnings and a small dividend hike. We got asked questions about Valmet, which happens to be a Finnish company. So I mean, it's so coincidental how we get questions around our topic, even though we don't release what our topic's going to be beforehand. We get questions about Warren Buffett and even fractional shares in Robinhood. So I'm quite looking forward to this one.
Yeah, definitely. And I think we should just get started with that one. And
yeah, we will. But we have to get the regulation side out of it. We are not financial advisors. We are just here for fun. And everything you hear about all these companies is our own opinion and not investment advice. But with that, let's talk about the news of the week. And the first one of note for me was around Merck. It's a company I did a deep dive on back in April. And I have to say I was quite impressed with what I saw. They are obviously known for their key drug, Keytruda. Now, you've done a nice piece before where you analyse all the top drugs in the pipeline, so you're very well aware of Merck. But Keytruda is a fantastic drug. It generates billions and billions and billions. But obviously there's risks around that, right? Because the patent expiration date is set for 2028. They're obviously trying techniques and tactics to try and extend beyond that. But let's take 2028 as the hard deadline. Around 45% of our sales come from this drug. I mean,
that's a lot.
Colossal. That is colossal. But look, management are aware of this. And I mean, they're not sitting on their hands. They're not sitting there in a boardroom waiting for 2028 to happen and not do anything about that. So they are aggressively trying to expand the pipeline, diversify it, and away from oncology and into other areas like immunology, which is what this company Cidara Therapeutics, they're called. It's what they're in that area. So I think it fits quite nicely into their overall goals. They also have another blockbuster, I would say, that they're putting their hopes on, which is Winrevair. It's this pulmonary and hyperextension drug it's estimated to make 15 billion. So like they are.
Wow, that's a lot.
It is now. Like analysts are kind of varied whether it'll make 15 billion. I mean, it's anywhere between 7 and 15, but it's still a decent chunk of revenue. So they are, I think, doing a good job at trying to diversify away from it. One thing that they do have is a really strong balance sheet and plenty of cash. When I last analysed them, there was around 14 billion in cash on the balance sheet. And Moody's had just upgraded them to AA3 as well, based on their financial position. So they're in a good position financially to do some of these acquisitions. And then we look at this acquisition. So they are looking to buy out Cidara Therapeutics. So who are they? I mean, I never heard of this company before. I don't know if you did. So I did a little bit of looking, and they use this proprietary Cloudbreak platform to develop novel drugs, drug conjugates, I think. DFCs is what they're called. I think you might be more fluent in this kind of sector, but these kind of agents.
I'm not.
I
You're
mean,
talking Klingon to me.
the thing about the thing about when you look at pharma companies, you see all these phrases, and then you look at it, and then you just go look up. What does this mean? What does this mean?
Yeah,
it's
exactly.
it's it's so difficult. But basically, from my understanding, these are like little agents that are there to inhibit disease by forcing some sort of immune response from your system. That's my understanding of it. They're like little molecules. I think it's a novel drug because it's not a vaccine, if I'm correct in that
Yeah, I see what you
understanding.
mean.
So quite interesting. So they put this into your body, and it kind of builds up a defense system against the flu. And if you think about it, we got a huge boomer generation, lots of old people that are probably the target market for this, that maybe can't
Yeah,
afford to get the flu, or it's quite dangerous if they do get the flu. So I think there's a huge market there for this type of, I'd say, drug, or
yeah,
whatever DFC is. But there's definitely a huge market there. I can see why they go after them. The details of the transaction was a little bit sparse in the release, but they are paying approximately 9.2 billion. So that equates to around 221.50 per share, which was a 109% increase on where the share price was trading the day
oh,
before. Imagine
shareholders
being
will
that
be happy there.
imagine being that shareholder, like
Yeah,
100% overnight. So look, they paid a premium at it. Transaction, as I said, will close in 2026. It's not entirely clear to me how they're funding this, but they do kind of hint that it will be an all cash deal. And they've got plenty of cash on their balance sheet. As I said, they
yeah,
have 14 billion on their cash back in April, and
yeah,
this is 9 billion, so they'd have some cash left over as well.
yeah.
So,
And there's more
uh,
cash floating in from Keytruda.
exactly.
You know, the thing is here, right? If when I hear you speaking, you need to work really in the industry as a biologist to kind of understand what this means. So we are not really familiar with the vocabulary. So this is what I always say about pharma companies. You need to judge them on the portfolio management. You need to, of
Yeah,
course, understand what's in the pipeline. You need to understand what the success rates maybe are in the pipeline. But that's the only way I think why I feel somewhat comfortable investing in big pharma, because it's portfolio management and you have a lot of time to see how that's impacting. You can see the drugs that they are acquiring or doing licenses deals with. You can see how it's growing over time, what the potential is. If management is words can be taken at face value, yeah, if you go 3 reports back or something like that. But if it comes to the biology, that's where I hook off. So for me, investing in biotechnology companies that are in the early stage, I would never do, simply
yeah,
because I don't understand the biology deep enough.
yeah. I mean, it's the thing I try to do, especially with big pharma like this. I mean, there's lots of big words. They talk about agents and CFDs and all this, and they're like, okay, that's a little bit over my head. What is this drug aiming to solve? What is its pain point? And
Exactly.
it's looking at the flu. Okay, is there a target market for this? Yes, there's a huge target market for this,
Yeah.
so it has potential. And I try to break it down that easy so my little tiny brain can understand a little bit about what it's doing. And
Yeah.
like, I don't have to worry about the acronyms or all that
Yeah.
fancy stuff.
Yeah.
Is it a good deal? Is 9.2 billion a good deal? It's a little bit early
It's
to
hard for us
say.
to judge.
Yeah, it's really hard to say. I don't know the projections around this,
Yeah.
and I'm sure more details will come out over time. But what I do like is management's execution in terms of what they've been saying in their annual
Yeah.
reports and what they're doing, and they are definitely on the front foot,
Yeah.
trying to reduce that reliance on Keytruda. And I mean, I look at AbbVie as an example.
Yeah.
They were trading at a valuation that was well below their peers until they started to see that turnaround. And I think Merck is
Yeah.
in that similar situation. If they execute it, it could be a really, really good opportunity at this moment. If they don't execute it, well, then you're buying at the top as well. So, I mean,
Yeah. You're buying cat in the bag.
exactly. So it depends on management execution.
Yeah.
But I mean, I own a couple of shares, small position, initiated them on the back of my deep dive. So
Yeah.
I'm quite happy with what I see.
Yeah, because the attractive thing of investing in big pharma is the dividend income, and there are many many good dividend payers. Think about Johnson & Johnson, AbbVie, Abbott Laboratories, right? Which is maybe not into drugs as such, but more into the medical. I said medical
Devices.
medtech. Yeah, there's just a lot of dividend stability in this market, but for those big pharmas.
Yeah. Yeah,
And we have them also in Europe, Novartis, Sanofi, and the likes.
yeah, yeah. Plenty of opportunities there, and they all go through their peaks and troughs. So the one
Yeah,
good thing about this market is there's always opportunities for the patient
true,
dividend
true.
growth investor. So maybe Merck is one of those companies. I mean, it's up for yourself to
Yeah.
judge, but I like what I see so far. Okay, we have some dividend announcements, and then we might move on and talk a little bit about Siemens and their earnings. But
Yeah.
Deutsche Telekom hiked their dividend from 90 cents to €1. I think that's on the back of the strength in the
Hmm.
US. They're growing in the US at the moment, so
Yeah.
quite a nice hike from them. Vodafone, who we've been asked about quite a few times on this show, actually hiked its dividend for the first time in 8 years. It was only a 2.5% hike, but the CEO was talking about the excitement and this new progressive dividend policy that they have, and they're expecting cash flows to increase over the next few years. Take that at face value, if you will. But I mean, if you waited 8 years for a 2.5% increase in your wages, I don't think you would be too
And that was
happy.
after a large dividend cut.
Exactly,
I still
exactly.
remember that dividend cut. That's how long I'm investing in dividend growth.
Wow. So Vodafone is never really on our list, but look, they've increased their dividend. ADP, quite popular in the group, hiked its dividend for the 51st time. A dividend king, and it was a good one. It was 10% to $1.70. It's quite a good
Nice.
hike from someone paying dividends that long.
Yeah,
Disney,
true. Do you own it, ADP?
no, I don't. Do
No?
you?
No, I don't own it, but I think we got a question from it. Maybe we can take it straight away. It was from Pinken. He asked our thoughts on ADP, and generally speaking, I would like to have this company in my portfolio one time. I so much like the reliability of this business, the data that it owns, that of course many people look at when it comes to jobs reports and numbers. So they typically deliver a macro indicator to the world. They have been so consistently growing. I think it's a sticky business. I think they have a lot of pricing power over time. But of course, it goes also a little bit with the ebbs and cycles of the economy, right? If
Yeah,
there are less people employed, you may expect ADP also to see pressure on the earnings, right? So I always have this feeling that it's a little bit too that it gets a premium on the market that I'm not willing to pay.
yeah,
Yeah. But then I see the dividend growth and I think like, what is it now? Trading at a 2.6% yield, 2.7% yield now. And I think like, well, maybe there are those days that I shouldn't be too greedy and think about it more from a dividend income point of view, knowing that their dividend has demonstrated over the last 51 years to be safe and growing, right? So maybe I should look more at such a stock from an income point of view and just think like, well, maybe if it hits 2.75% or 3%, just pull the trigger and own it. Don't
yeah.
trade it. Yeah.
You know those companies that teach you that you should never time the market. Like when you
Yeah.
when you buy them and you sell them thinking they're overvalued. Yeah,
Yeah.
ADP is
ADP is one of them.
ADP is one of them for me. And if you go back in my early days of the blog that I don't manage anymore, by the way, but Engine My Freedom, I think this was one of the first companies I actually wrote about. I really, really liked the company.
Yeah.
But again, I got into my head like I was some expert at valuation and the price was overextended and it was going to fall and I was going to buy more. And I sold and I think it nearly doubled in share price. So it's one of
Yeah.
those I look back on and not regret because it was a good learning opportunity. But yeah, it's a company that I really do like. They have a
Yeah.
good history, but for some reason, I mean, we got so many companies that we look at, they just never really
Yeah.
come up on my
But I would
screen
I
or
would
anything.
put
But
ADP really at the higher end percentile of the spectrum, or totally right in the normal distribution.
yeah, me too. Me too. But nice company all the same. Aflac announced another 5.2 dividend hike. This makes it 43 straight years of increases.
Yeah, this is crazy. And I saw today on Twitter, I saw a guy showing his his purchase history of Aflac, and he did it all in 2020 for $23 or $24. So
I
he's
remember.
he's looking at a nearly 10% yield now.
Wow, I remember.
I mean,
And
these insurers, they got beaten up during that
yeah,
time, but look
yeah,
at how they all bounced back. It's unbelievable. People talk about tech stocks at the time, but insurers have been really, really great growers
yeah,
if you bought them there around the bottom.
yeah,
Amazing.
crazy times. And of course, our good friend Tiago was speaking about these for a long, long time on his own social media and stuff. So he's done quite well. But yeah, sticky business. Big in Japan as well, I believe, which gives you a bit of diversification. And yeah, 43 years is quite nice. And then finally, we have Siemens, a company that I speak really, really highly about, but they only hiked their dividend by 2.9%.
Yes, and that's interesting, right? Why was that? So I want to bring, I at least wanted to also talk a little bit about the earnings here, because I think there's just some clarification behind it.
Good.
Simply said, how I look at it, I found that the Q4 earnings were poor on at the surface, because, for instance, their order intake declined by 4% and the revenue only grew by 3%, and the net income and EPS, they declined by 14% year over year. That doesn't look good, right? When you hear this, they do say that net income was impacted by kind of higher negative results within the reconciliation of the financial statements. It's a technical bookkeeping term,
Okay.
but it's not entirely, because if we zoom into the units, right? Digital industries grew by 30% to 5.5 billion. And this is what I think is very important to understand. They have this software business, effectively product lifecycle management. I think you and I are quite familiar with that from our history of employment, and
Yeah.
also electronic design automation that I'm also quite familiar with. I mean, the software sales are really strong for this business unit, so really impressive. Smart infrastructure, on the other hand, only grew by 1% to 6.2 billion in terms of revenues. But where it really comes is that mobility declined by 45% to 2.5 billion. So they were doing more than 4 billion. And, but if you go a little bit deeper there again, they just had an exceptional Q4 last year. Yeah.
Yeah.
Lots of order intake. So what you are experiencing here is just a reverse to back to the mean. But then there's Siemens Healthineers, a 2.2% decline to 7.2 billion. Yeah, which I think is a little bit of the weak part in here. Now, if we then zoom in the annual results, because we're looking at that one as well at the same time, then we see a really nice story. We see that the company grew from 76 billion to 79 billion in revenue. They have a net income, or let's say they have a earnings per share of 9.6 versus 10.4. So there's a bit of a decline there, and that's related with what we just mentioned. So if we look at it, generally speaking, it looks good. A bit of cost inflation in the business, which hits the earnings per share, but they hiked the dividend to 5.35 cents, and if you have an earnings per share of 9.6, it's really well covered. Also, the free cash flow is very strong, 10.8 billion. Yeah, and they have only 4 billion in dividend payments, and the free cash flow is stronger than last year's. So this is just all very good. So why only then at 2.9% if they can grow so much? Well, there's one catch here. They already started to kind of, I said, spin off Healthineers at the time.
Yep.
So they still own 69%, and I think they're going to spin off another 30%, and we as shareholders will get some shares for that. So last time, what they did with Siemens Energy, they actually gave us a dividend cut. A small one, I think 10%, if I remember correctly, or 15%. But we got the Siemens Energy shares. I sold them. Well, maybe I shouldn't have done, if you look at what Siemens Energy has been doing over the last year. amazing. And I think Jeremy from our Facebook group shared even like that they initiated a dividend, and he also showed the performance. I felt like, oh, one of those feelings. But yeah, so I think we will all get some Siemens Alphaneer shares, which you can treat a little bit as a dividend as well. But it's a dividend out of our own pocket, because you get less of a business in return. On the other end, you could say that this is a dividend always, right? It's a distribution of profits. In this case,
Yeah,
there will be a little bit of a distribution of assets coming to us.
yeah,
So not too bad actually when you probably all combine that.
yeah. Not too bad at all. And I was surprised when I heard you talking about the results, because I remember looking at these over the last 3 quarters, and they've been quite good. So
Yeah.
this quarter has obviously been a sticky quarter
Yeah,
for them.
and,
But
and, and the company is really, they just also had this week their Capital Markets Day,
oh
and
yes,
they have
yeah,
some big strategy announcements there. But I think that's something we'll take into the newsletter to go a little bit deeper there,
yeah.
because we go there in the nitty-gritty detail.
I need to take a proper look at that and
Yeah,
see.
so
But
maybe not for this weekend, but for the next one, if we don't make it.
it's good to see automation is back,
Yeah.
after a tough period. But I can see that. I can see that in my own place as well. Spending goes through cycles,
Hmm.
and um, we're in this
Yeah,
AI
it,
boom as
it,
well.
it, it continues to be a powerhouse, and I believe the company went 7 or 9% down after earnings. So you may
Oh,
want to have another look if maybe now becomes a time to start buying a few shares here and there. It's
is
still
it?
you're still
Is
price anchored, I think.
it? I was going to say, is it under 100 yet?
No.
Anyway, let's move on to Scandinavia and the Nordics, where we are picking three companies that we quite like. From my end, I quite like. As I mentioned in the intro, we went to Scandinavia. I mean, it's a big part of our following. We've got lots of people from these areas. We get lots of questions
Yeah.
about companies. There's actually three companies that were not in this list that we looked at that are actually from that region. So it kind of shows that there's lots of really, really good companies here. Of course, we picked three. From what I was looking, we could have picked easily 20,
Yeah.
30 companies that fit the bill. But I'm quite excited for this one. Like, one thing I look at when I think of Scandinavia is that they always seem to treat their investors like adults. Not like
Yeah.
over here in Ireland, where we can't invest in certain things and they have punitive taxes on ETFs. I mean, they really look after their shareholders over here.
Yeah, and this very interesting, and of course, maybe not to the foreign shareholders, because a 30% dividend tax on Sweden is not something necessarily that I'm happy with. But okay, but did you know that actually not too long ago, also the European Commission or the European capital markets really started to they went to the Nasdaq in Stockholm, right? They're really to understand like what's going on in Sweden, what makes Sweden so special, and also the European Union is very interested in it because there are quite a few interesting things. Because there's a large IPO market. For instance, over the last 10 years, there were more than 500 IPOs, I believe, in Sweden.
Wow.
And these are many small businesses. Yeah, only the UK did more over the last 10 years, but the UK is a much larger market compared to Sweden. So there is something in this country that allows many small businesses even to just IPO and go public. And if you think about the percentage of listed stocks where of firms with 250 or more employees, it's more than 50%. They really stand out. The Swedish companies are so much more likely to be listed than any other European in any other European country. And I think there are a few things of it, because also a lot of large institutional investors in Sweden, they invest in this. For instance, large pension funds, yeah, and they even support IPOs often, yeah, and also Swedish insurers in general. They're one of the top equity investors in Sweden with almost 50%. So if you think about it, where it comes from, so many Swedish households, for instance, also they have one of the highest proportion of their investments in the stock market, and one of among the lowest in just bank deposits compared to other European countries. And if you look at the data, which is interesting because we often talk about financial literacy and we don't teach it at school. According to the statistics, Germany, France, or Spain, the population is more educated on financial literacy than in Sweden. Yet in Sweden, more people are investing. Maybe it's dump money, but I think there's something more behind it because
Yeah.
if you go back to a bit, I really found a nice article to look up on this. And one of the reasons behind it is the introduction that the government did in 1984 of what they call allemanspaar. Um, I'm Dutch. I can't understand the word of Swedish, but this sounds like allemans, which means everyone's, and spaar means saving. So that means a savings account for everybody, I think. That's what it probably literally means.
Yeah.
But it allowed them really to start investing in the stock market. And then also there were some rule changes in the 90s, which allowed people to invest 2.5% of their a pension amount and allocate it into funds of their choice. So this really, I think, also interesting, right? That there came some direct um, ownership or direct influence on what you want to happen to your pension by investing it in a bit in the stock market. And then in 2012, the Swedish government really introduced those investment savings accounts called ISKs. And this is where the European Union is really interested in because it allows individuals to invest without needing to report any of their holdings or worry about capital gains or a dividend tax. Instead, the total value of the account is just taxed. And I think that's about 1% what is being taxed. So if you there have a 3.5% dividend yield on your portfolio, 1% goes to the taxman, which is probably kind of an equivalent of the 30% dividend tax. On the other end, you don't have capital gains tax there, so you can easier move out into positions. For instance, for me, selling Apple is painful because of the capital gains tax that I'm needing to pay. Yeah,
Yeah.
so I think there are a lot of benefits there that I guess Swedish people are aware of and started using. In Poland, we have something similar. We have also a few of those investment accounts. They are kept to a certain limit. They also, free of dividend withholding tax and such, but you can only withdraw at a certain age. So those are typically vehicles reserved for retirement. I believe the UK has something as an ISA, but what I read about the Swedish setup, it sounds much more progressive. And yeah, it would be good also maybe in our Discord or Facebook if some people clarify a little bit more about the magic of this. But then if you then think about the total stocks held by households in Sweden relatively to other European countries, you need to know the average of the EU is less than 20%. Sweden is more than 40%. Followed by Denmark and Finland that have also more than 30%. Then almost comes nothing, and then Italy and Germany and France with less than 20%. So it just shows the amount of investor participation into the stock markets in the Nordics that we are talking about today.
Yeah. Yeah. And I mean, listening to you talk, it's very apparent to me that their governments and policymakers make it easy for households to invest. There's no restrictions, there's no rules. I mean, it's just so easy. And when you do that, people are willing to educate themselves. But I think when you put barriers in place, people might look at it. And I'm going to take Ireland as an example. People don't know where to start in investing over here. They look at property first, and then, I mean, the huge cost of capital there. You have to take on large amounts of debt and remortgage just to get a second property. That's quite difficult at times if you don't have access to that. Then you look at ETFs. Okay, you have to file taxes every 8 years and pay gains on imaginary selling, basic capital gains tax without selling a stock. So it's quite difficult over here to know where to start. What's the best option? Where over in Sweden, Finland, it's just like, okay, we make it easy for you, and people will respond to that, and they see
And we
much
know
much
this from our
benefit.
friend
Of
Alan.
course,
He
of
he, he
course.
gets like all the dividends back from wherever he buys them. Like the bank all automates this for him and does it automatically. And even he's talking about commissions of 0.1% or 0.01%. And I think like, oh my God, I'm so jealous. That would be a
Yeah,
reason to immigrate to Sweden. Yeah.
yeah, yeah.
Oh,
Hey,
so
who
we get to
knows?
explore it in Malmo in
Yeah, yeah.
January to see if we want to
So
actually live there as well.
Who knows? Yeah, we might not come home. We might stick around in Malmo.
Yeah, and
But
I probably should do it on time before I get to a certain level that I have to pay an exit tax, because they also have that in Poland nowadays. So, do you have it in Ireland, an exit tax?
no, not yet. Not yet.
Not yet, but they're probably thinking about it, right? Because all those countries in Europe are currently worried about the rich people leaving.
Exactly, exactly, and we'll follow Europe. Whatever Europe does, we will follow. So I
Yeah,
would say it's coming, even though I haven't heard anything. But look, lots of good things as we spoke. We picked three companies, and what we do is we kind of look at them through our dividend safety lens. And we try to keep it as simple as possible. We look at it under five kind of key points. Does the company grow? What are their growth prospects going forward, which I think is also important? Do they have a healthy balance sheet? Can they afford the dividend? I mean, that's super important. And then have they demonstrated commitment to the dividend? And I think those five pillars for us are kind of what we stick to. I mean, they
yeah,
sound so easy, but there's a lot of research that has to go in each of those points individually. But
exactly. Because there's a lot of business analysis involved
yeah,
in all of this. Trying to really, you can't borrow conviction. Really trying to know what you own.
I have that hoodie on.
Yeah, good one, good one.
Yeah, but look, we'll keep this a little bit more. I mean, it's an hour podcast, three companies. We'll keep this more high level, but yeah, three companies that really stood out for us. And I'll start because a company that has been kind of popping up on our radar has been a company called Mandatum. I did a little bit of a look into them last year. They only kind of initiated dividend. So to be clear, they're only paying a dividend for a couple of years. So, I mean, the fifth part of that question, have they demonstrated commitment to the dividend, is a little bit hard to, I mean, answer that question. But we'll go through them bit by bit. So, what are they? They're a financial services provider based in Finland. They have this kind of structure where Mandatum is the parent company and it owns two major parts of its business: Mandatum Life, which looks at insurance, and then they have one that looks after the asset management, which I think is Mandatum PLC. They have a nice little hierarchy graph on their About Us page, and it has Mandatum sitting on top, and they've got four branches sitting off it and two more branches. But essentially, we can look at it as two main businesses. We look at insurance and we look at asset management. We know what insurance looks after, like pensions, personal risk insurance, reward bonuses for companies, and then the asset management runs investment funds as you would expect. So quite a complex structure to get your head around, but overall, I think both businesses kind of complement each other quite well. So, do the company grow, and have they been growing? Well, in 2024, I looked at their annual report, and it increased its assets under management by 17%. For context, this company was established in 2021, and their assets under management was around 11 billion. So it's up to 14 billion now. So you can see it's grown quite steadily since its inception. Net flows have risen by 30% year over year. I think it was an 8% growth in 2024. Um, they are a capital light company, which is quite important for them. And their fees on the back of this has grown 27% in 2023 to 2024. So, I mean, it's
But
grown
are they
quite
then
strong.
screwing their consumers when I hear those growth numbers? I mean,
I mean,
imagine being the client of that. So
yeah, are they increasing their premiums, and are they? We'll get to that a
yeah,
little bit later because
okay,
I probably our insurance companies are in essence we want them to grow, so premiums have to go up. So like they're going to make money by two ways: either they're going to take in more premiums or they pay out less money in insurance.
yeah,
You can It's hard to predict the second one
or acquire more customers.
or acquire more customers. But I mean, it's hard to predict who are going to claim against what and when.
Yeah,
But it's easier to maybe attract new customers, and it's easier again to increase your premiums. So
yeah.
effectively, yes, I would say, and that's that. They would be screwing out their customers. Um, their long term priorities, from what I've seen on their investor presentation, is to prioritize growth in the capital light business, and that means the asset management business. So that's where the real growth is, and not actually the insurance company. So when you asked, are they screwing out their things? What they're trying to do is gradually run down the capital intensive part of their portfolio, which is the insurance. So a lot of their insurance kind of policies were sold back in the 80s or the 90s, and these are kind of capital heavy because they have these like fixed guaranteed returns of 3 to 4 to even 5%.
Like life insurance and such.
Exactly. And the problem is that Mandatum need to cover this
Yeah,
regardless of market conditions. So
yeah.
they are trying to run this portion of the business
Mhm.
down and focus more on the asset light
But
on
isn't
higher
the asset
margins.
management business more volatile towards market swings? Because
Correct.
you typically get a revalue of assets, right, on your at that moment in time.
Exactly. Depending on what they're invested in. They could be invested
Mhm.
in, I mean, some asset managers invest in property, stocks,
Yeah,
bonds, and to
yeah, yeah.
cover that out. So depends on what they, now I didn't go into that level of detail on what they're invested in, but I would imagine that they're well diversified in that. The addressable market over in the Nordics is quite large. It's estimated at 1,000 billion, which is a trillion. But it's quite a large, and they only have a small increase of that, a small portion of that at the moment. So I mean, there's a lot of scope there to grow over the next couple of years, and that's just in the Nordic region. They're also expanding internationally. Their AUM internationally grew 67% with acquisitions in Sweden, in Denmark, but in Central Europe as well. So they're starting to move westwards a little bit. So there's lots of scope for them to grow. I looked at their solvency, which we always look at for the insurance part of the company. And they have a target ratio of around 170. Now, this was re-rated. It was between 180 and 190, or 180 and 200. Now it's down to 170 to 190. And the reason they're re-rating it down is because they're trying to get rid of that, as I said, capital intensive part of their portfolio. Once they start whittling that down, they don't need as much cash. The good news for us is that will free up cash on the balance sheet, which will allow them to invest in either in the business or to give us more dividends or buy back shares. So they're going to be freeing up cash in that portion. So it sits at 210 at the moment, so it's well above their target. So there's plenty of buffer there, and I'm expecting another large increase from them next year. They have a Moody's credit rating of BB, which is quite strong. Yeah, and I think it's a stable. I think it will be a stable dividend player. I mean, they've only initiated dividend in 2023 at 33 cents. Their next dividend was 2024, and it was 66 cents. So it's doubled in share price. I'm again expecting another large dividend hike next year on the back of their solvency ratio being so high. They have a lot of cash to spend, and they will reward shareholders. And look, the company have explicitly said that they aim to be a stable dividend payer.
Yeah, and they pay like 5% now, right? Is
Ten
that it?
percent. 10%. I mean, it shows
Oh,
5% on some of those
yeah,
websites, which is why you can't always trust them.
yeah, yeah.
But their dividend is actually 66 cent and not 33 cent. So they've increased
Oh,
it.
wow.
And they trade at
That's a 10%
€6.
yielding company, and you
10% yield.
expect another large dividend hike.
Yes, yes,
Jesus.
I am. And I mean, I honestly think that the dividend is safe. And again, it all goes back to the solvency ratio, which is sitting at 210. The target ratio is 170. So there's a
Yeah.
lot of buffer
But
there.
usually a 10% dividend yield is a huge red flag.
A huge red flag, and they're in their infancy. But like, I don't think anyone expected them to do a 100% increase from 33 cent to
Yeah.
66 cent, which obviously inflated. But the share price might catch up to that over the next
Yeah, because usually
years.
10% yield would, if it is safe, would be a sign of a huge undervaluation.
Yeah, exactly. And the 10% yield came on the back of a large dividend increase rather than a share price depreciation. So they created this large dividend yield themselves.
Yeah.
But yeah, overall, I think the signs are pretty good. I mean, asset management is an interesting business. It's growing. It's growing strong. They're growing into Europe. I mean, we addressed the addressable market, so there's lots of scope here for growth. I
Yeah.
believe from Finland, it has a really good name. Lots of Finnish investors keep screaming at us to look at them. And
Yeah.
I generally think it warrants a deeper dive because it is definitely super interesting, and it's going to be interesting to see what happens to their insurance part of the
Yeah,
business and
and
how they
interestingly,
manage that.
they're at the all-time high. Yeah, and
Yeah,
like earlier this year, or let's say at the start of the year, you could still get them for like for €4.50, and now they are €6.40. So that's
Wow.
quite a growth in a single year, and then still at a 10% dividend yield. It's crazy.
Yeah.
It's
Yeah.
crazy. I've
Good.
not seen this ever really. So maybe now I get finally this wake up call after people in the Facebook community talking about Mandatum regularly.
I mean, we don't learn our lesson because we've been told about this company so much, and I did look into them for the newsletter as kind of like a
Yeah,
little subsection.
yeah,
But I think the problem was that they've only initiated a dividend at that
yeah,
time. I was unsure of. We had 2 years of growth behind them. I know it's only
yeah,
4 now, but I wasn't sure. They were on the fence and on my
yeah,
watch list, but so far down on my watch list, I never
yeah,
watched them. But I think now that I've actually looked in them at a high level, they tick all my boxes. I mean, we go back to
yeah,
the dividend safety. Does the company grow? Yes, it's growing. Still
yeah,
early, but yes, it's growing.
yeah,
What are our growth prospects going forward? I mean, asset management is where that's at. We have a
yeah,
big addressable market, but they're moving into Europe. Do they have a healthy balance sheet? Yes, they do. They have solvency ratio more than covers the
hmm,
dividend and higher than their target. Can they afford a dividend? Yes. The only question is, have they demonstrated commitment to the dividend? You can say
yeah,
if 100% increase is commitment, but it's still, look, we don't know what this company is going to do when it hits
yeah,
signs of trouble. So that
exactly.
one
Yeah,
is out for questions. So,
yeah,
but overall, yeah, I think it's a wonderfully run company, and I can see why a lot of
yeah.
Finnish investors are invested. And fair play, if you got into them at €3-4, I mean, that's
Yeah,
some
and
nice
one of
capital
our
gains.
Facebook users often posts also nicely what cookies and coffee we get at the shareholder meeting there.
Yeah, yeah, we do. We actually speak about another company later in Sampo, and we have
Yeah,
people that go to invest their
yeah, yeah.
days on both of them. And I mean, I'm so jealous. They get so nice things.
Yeah. Maybe we should also go more. Yeah, it sounds really good. And, I'm a big fan of these kinds of companies, right? It will still be hard for me to ever invest in them when I have Allianz already and N Group and ASR and Chubb. But never say never. Never say never. Good. Hey, I want to bring you a little bit into your space, actually, because I would love to talk a little bit more about Atlas Copco. Yeah.
Nice.
Difficult name, but you need to know that Copco comes from a Belgium acquisition 60, 70 years ago, and they used that abbreviation of that company to put it in the name as well. I think some goodwill to the let's say partners at the time, but it has lived on since then. You need to know that this company, Atlas Copco, is already around for 150 years, more than 150 years. Yeah, it started in Stockholm, and it was initially focused really on establishing the railroads in Sweden. So they were the first, how is it, to build products for trains and railway equipment and everything what was needed at the time. Um, but in 1948, you can say by then it really moved into a company that we know today. It was a little bit into the diesel industry at the time as well, had some near bankruptcies, but from let's say after Second World War, really concentrated more on equipment for air compression, tools, drilling equipment. And I think that's kind of how we know the business today from that origin. What I do want to say is, like, before I go into what this company is all about from a business model, from a business unit point of view, it is a serial acquirer. Yeah, it's like a little bit like L'Oreal and these companies that are anchored in the industry. Um, our British company that I analyzed not too long ago had the same. What was the name again? Sorry, I went.
Bunzel.
Yeah, Bunzel. Same. Yeah, those are companies that you need to expect them to continuously be on the hunt for other companies. So a large part of the growth comes from acquiring businesses. So, and that's relatively easy to assess because they have some rules and you can see how the company is doing with that. But when we think about this company and its core business, we really need to separate it into two businesses. One is selling equipment, and then we have aftermarket services. Don't be mistaken, the aftermarket services is 37% of revenue. which is a lot. You need to think here about maintenance of this equipment, repairs, da di da di da. So what equipments are we actually talking about? So you need to know this company is set up in four, let's say, four business units. Compressor technique. So we're talking about filtration, chillers,
Yeah.
industrial gas, high pressure. I think you're quite familiar with them. Vacuum technique. So we're talking here about liquid ring pumps, gas vapor delivery, valves. We have industry technique here. So we're talking about electronic dispensing, machine vision, inline quality control, and with power technique. So surface pumps, steam rental, industrial pumps. And I think some of those you're very familiar with if you go to a festival or something like that, and you see those big generators that are providing electricity to the stands, to the food trucks. I think that's what you may know them from.
Yep.
Um, at least that's something that consumers typically know them from. So when you think about this, there's something that I really like about this business, because we're living in a world of geo-shifting, outsourcing, and everything and everything. And if you look at American companies, they didn't do anything anymore themselves. It's all done by third parties. Think Apple, yeah. But Apple also came back to that. Apple started to build their own chips. Yeah. Atlas Copco learned this lesson already many decades ago, and all the critical elements of the equipment they sell, like the real critical one that gives them an innovative edge, is what they produce themselves. All the rest, the standard stuff that you need to put into it, that's what they take from other parts of the world and other suppliers. And I think that's smart, because you shouldn't sell out your crown jewels, because that's where the innovation comes from in these products. Yeah,
Yep.
if you start outsourcing the critical elements of that, you will lose a capability to spot new trends and develop them quickly. So I think this is very important what they are doing. And if management would ever give that up and start outsourcing that stuff, that would be for me a reason to sell, because that would be the beginning of the end.
Yeah, I
That's, in
agree.
my opinion, what you could say intellectual property of this company. And that's unique still, I think, in the world of outsourcing that we have seen since the early 2000s. What I do want to stress out is that, they're operating in industries like manufacturing, electronics, and construction, the chip industry. So you need to know that their customers are all very much in a cyclical market. Yeah. So we know what happens at the bottom of a cycle. They will reduce their capex to protect their balance sheet, to protect the dividend, whatever it is that they are doing. Atlas Copco will feel that. Yeah. And that's also a reason why they really focus on their balance sheet. And I would say their balance sheet is really strong, Derek. They have 26 billion in long-term debt, but 19 billion in cash and 113 billion in equity.
Wow.
Effectively, they have almost a debt-free balance sheet. So that gives this company, of course, also a lot of firepower, right? In those moments under stress, to actually acquire stuff, because they have all the means to leverage up. And I think that's also good to
It's
know.
it's impressive, right? Considering that they're a serial acquirer and manage that
Yeah.
so well.
Yeah, they're mostly doing it out of cash flow.
Mm.
So also, you don't need to own Atlas Copco directly. If you want to own it in a bit more of a diversification, and also a company that has a good dividend growth track record, you can just go and invest in Investor AB, a company we don't talk enough about. We get this feedback also. It's really on my list to one time maybe do a deep dive about. But they have a 17% stake into Atlas Copco as well. And actually, Investor AB has been very essential in its history. I think it helped with the, I don't know if it was in the late 90s or something like that, with really keeping the company alive with the required capital for Atlas Copco. So if you think about it, there's no full deep dive. We have a full deep dive available in our premium service. So if people are interested and they don't have a premium subscription yet, I would say do sign up. And that's as much as promotion I will do. We're bad at promotion, you know that. But the first one is like a question then is the business growing, right? So if we look just at a few high level numbers, An 11.2 revenue CAGR over the last 5 years, so 11.2 growth on average, and 12.5% in net income. Free cash flow also grew from 3 Swedish crowns in 2019 to 6.7 right now in 2024. Interestingly, though, if you zoom in, really the growth comes a lot from Asia and their compressor technique business unit. But I do want to say that the recent quarterly numbers were relatively weak, even showing some decline due to the global industrial environment that we're operating in. Yeah. So I think it is having some headwinds at the moment. So if you think about growth prospects, I think these are strong through the cycles, not necessarily at a moment in time in a cycle. And I see two important catalysts. What I see happening at the moment under the influence of Trump, generally also, geopolitics has been shifting. So there's a lot of backshoring of manufacturing, bringing manufacturing home. Europe is also thinking about that. When you're doing that, equipment needs to be maintained. For DHL, for instance, it's again a catalyst because they get to ship a lot of it. But also when you then build a new manufacturing plant, maybe some of the equipment from Atlas Copco is needed. Yeah, so that's
Yeah.
how I look at it. But of course, we have a boom in the chip industry, and also here they sell a lot to that industry. So I also expect there to continue to see growth there. So if you then ask about the company if it has shown commitment to the dividend, well, we have seen a slight dividend cut in 2018, so it is only technically 6 years of growth. But if you zoom out, you see amazing dividend growth over time. So what I only want to say is like management may reduce the dividend a little bit, but I think it happened twice in the history since 1983. Yeah, I think in 1988 it happened once, and then I think in 2018. When we talk about the dividend cut, we're talking about dividend cut from 175 to 158. So take that into consideration as well, that this was like less than 10% probably, around 10%. And you need to feel comfortable with that, with such a salary cut, but do know that since then, when it was 175 pre-dividend cut, it's now at 3. Yeah, so nearly doubled in the last 5 years as well. It also had sometimes a flat dividend, for instance, during the great financial crisis in 2007, 8, and 9. So I do think there is commitment to the dividend, but yeah, like I said, you may see sometimes a slow cut. Can they afford the dividend? Yeah, there's no question about it. I think that the current payout is around 45%. They have this policy of 50%, but they can afford that. Also with a clean balance sheet. And we talked about the balance sheet. So yeah, I think that the dividend is safe here. That's actually my conclusion. I find it a really nice business to study. I find it a nice, well executed business. I think Swedish people should be proud on this business as well. And then the question is like, do I want to have it at this price? No, I think at a PE at 25 is a bit too much for me. I would like to go maybe for a 20 PE, preferably 3% yield, but it yields 1.9% now. So that would be maybe a bit too much of an ask. But we have seen Walter Kluwer. We didn't actually talk about it, but the price dropped to 93 euros from 170 or 180 at the top not too long ago. Maybe this will happen to Atlas Copco as well.
Yeah.
But of course, then the whole narrative will have changed around this company, and you'll have to have your conviction. But my deep dive supports me here.
Exactly, and it's just around the dividend safety. If that happens, what happens with that? Because they have cut it twice, which would be my biggest concern when you look at commitment to dividends. They've done it before. Will they do it again? Maybe not. It's hard to look into the future, but
yeah. But how I look at it, they may do it again, but these will be small cuts because it's all business led. And if you see how strong the business has been growing over time, that there would be needed a very, very fundamental change. I don't see that happening with this company anytime soon. The flywheel is spinning.
So in dividend safety, it's safe over time, but it might have a few bumps in the road. That's
Yeah,
effectively
yeah,
it.
yeah, yeah. I think that's how you need to look at this company, and it's because of the 50% dividend payout ratio.
Yeah, I think given the dividend tax in Sweden, and knowing that they might have a few bumps in the road, I don't think it's for me. It's a great business. Some of their products is fantastic. But I look at someone like Spirax in a similar line, not as
Yeah.
diversified, obviously, but maybe a safer dividend in my opinion.
Yeah,
But
but I think you need to look at it from low yield, high growth point of view. And
yeah,
also, this is maybe a company you buy better at the cycle, if and then it could be yielding
exactly.
3%. But you know that when it bounces back, you can get really high growth.
Yeah. Nice. Okay. I'm going to go back to Finland. I have some affinity with Finland the last while. I think it may be because the withholding tax for Irish residents seems to be 15% because they have a treaty. Whereas I don't believe it's the same with Sweden. So that's probably why I lean more towards Sweden. But a company I had to look at was Sampo. Again, it's another company that comes up a lot in our social media circles, and Mandatum was spun off from them, so they must have something. But they are a leading property and casualty insurance group. And that basically means that they are an insurance group for houses and cars. They are across the whole region of the Nordics. So they're across Sweden, Finland, Denmark. They are everywhere. And they are the largest by a mile. And I think they're the only P&C insurance group throughout the whole Nordic region, which I think is quite crazy. One thing to note is that you will never see that name when you're buying the insurance. So Sampo itself is a listed holding company. It does not conduct insurance business directly. Its operations are carried out through some of its subsidiaries. So you might have heard of IF, Hastings, and Top Denmark. The group's focus is on non-life insurance, so the stable, cash-generating kind like home, car, and business, as I mentioned before. And they grow in kind of private and small business markets throughout the Nordics. What's also interesting is that they are expanding, especially in digital insurance in the UK as well, which I think is quite interesting. So, how do they make their money? They have two main profit drivers. The first one is underwriting results, and these kind of reflect your premiums collected minus claims that are paid out and operating costs. So we spoke a little bit about that for Mandatum. In 2025, the 9 months from January to September, underwriting results grew 17% to just over 1.1 billion. This was driven by strong premium growth and healthy margins. So we look at premium growth. You asked if Mandatum are screwing out their customers. Technically, you could say the same about Sampo here, as they are increasing their premiums. They also do a lot of investments, so they make money from investment returns, and that rose 46% in the 9 months of 2025. And this was supported by gains from an IPO in a company called Nova, N-O-B-A. In the first 9 months of the year, again, they grew 8%. So the gross written premiums, as they put it, GWP, they only grew at 2.55%, whereas their underwriting results grew at 13%, and their earnings per share grew in tandem with their underwriting results. It grew at 13% as well. Solvency ratio, which is quite important for insurance companies, stood at 172%. This is smack bam in the middle of their range, which is between 150 and 190%. So quite solid on that front. The financial leverage is what they call it, essentially is debt to equity. It was at 24.5%, which is well below their 30% target. So quite strong. And Moody's have them at an A2 credit rating. It was actually quite nice going through some of their investor relations, because management explicitly states on the balance sheet that it's strong enough to support high dividends. The yield is only around 3.5%, so not high in terms of high that I like it, but still a
What a
substantial.
bummer.
Yeah,
What
I
a
mean,
bummer.
we're talking about 10% with Mandatum, and we're back down to little old 3.5. But look, I think it's a steady dividend yield. They have been growing dividends for 31 years, or at least paying out dividends for 31 years. So they have a strong commitment to the dividend. Its policy is to pay at least 70% of operating profits, excluding ordinary items, and this is paid out annually. So I love this about European companies. It's explicit. Here's what your dividend
Yeah.
policy is, and
What you see
it's
is what
easy
you
to
get.
track.
Yeah.
Exactly, it's quite nice. And they are a fan of paying out special dividends. So when I was looking at the dividend history on there, so the first thing I looked at was dividend history, nothing else. And I was looking at the IR page, and first thing I see was 2024. It was like 34 plus 39. I don't have the page open, but it looks like there was loads of dividend cuts along the way. But actually what they do is they pay a regular dividend, which has been growing year over year. But they also have extra dividends, buybacks. So there's a lot of special
Wow.
dividends over the last
Nice.
3 or 4 years. So
But
the
that's
return,
like getting a bonus at work and starting to count on your bonus and being disappointed when there's no bonus.
yeah, they don't do it every year. They've done it more so in the last
Yeah, that's
couple
what
of
I
years.
mean.
Yeah,
Imagine
yeah.
because I see the salary. So imagine you get used to your bonus at work and suddenly you say like, well, sir, this year, no.
So that's where you invest in CME Group because they
Yeah,
do a special dividend that's special every
yeah.
year.
And that's why I think at work you should never really
Count
account for your bonus in your expenses and budget and just see it really as
a bonus.
try to live without your bonus. Yeah, and I know that for some jobs when you're in sales and your bonus is like 50%, it's another story. But I always try to look at my bonus as really like something unforeseen. Let's say.
I do. I don't even count it in my salary
Yeah,
at all. And I'm
yeah,
always like when I know it's coming up, and I'm like, oh, surprise! What am I going to get?
yeah.
But I never.
Are the bonuses big for you that you get at work?
No, not massive. No,
No.
not. No.
Okay.
Does okay. I suppose in
Hmm.
the industry I'm in, they're probably around the average. But
Yeah.
I can tell you in my last job before that, I worked for a systems integrator, and the bonus was out of this world, crazy.
Yeah.
And I'm
Oh,
talking nearly 100%
wow.
on a substantial wage, depending on what's really good about it, depending on how well you worked.
Wow. Nice.
So you were rewarded for what you did. But yeah,
Yeah.
it's not at that level, but it's at a good level. But yeah, back to Sampo. Look, 31 years of paying dividends. They're in the insurance group. We know we like insurance. I probably have a little bit too much of these types of insurance companies. And if I was to pick between them and Mandatum look a little bit more attractive to me. And maybe
Yeah.
that's the 10% yield
It's
you're going to
funny
say.
that you say that because sometimes I have this thought like if I would turn my whole portfolio into insurance stocks, I could retire. I could just retire on insurance stocks.
And we could write a book about how you don't need to diversify.
Yeah. No, but there are people that are fully investing only in real estate investment trusts, right? We could do it in
Yeah.
European insurers and,
I
and,
t-
and
do
count
you know,
money like Dagobert Duck.
I mean, like it's easy to make money when everything is going up. But there's people
Yeah,
that do that, and they specialize in an area. I know there's a guy,
yeah,
Jay Mortimer, that does shipping. I say on
yeah.
Twitter, very interesting guy. I follow him. I think he's great, but you have to have, I think, a deep expertise in that industry to have the cojones, I would
True,
say,
true.
to go all
We're
in.
just addicted to dividends.
Just addictive to dividends and
Yeah,
looking at the number. I mean, if we had just sold our portfolios in 2021 and said just
yeah.
buy insurance companies, we could be sitting here talking about how easy it is to get the financial freedom and
Exactly,
all that. But
exactly.
that's not real life. But
No.
yeah, insurance. I mean, I think last year we said we had enough insurance, and it just they're just so attractive. It's hard not to buy more and more.
Yeah. I have enough as well, but sometimes I feel like, is it really ever enough? But that is why we need to have rules in place. It's
Yeah,
tempting. It's so tempting.
it is. But look, the nice thing about Sampo is that they are expanding outside of Nordics, and that digital insurance space in the UK is really growing. And I think insurance in the UK in general is probably a good area to be in. So, yeah,
Yeah,
two interesting companies, two financial services companies.
yeah,
There's lots more that we could have looked at, as we said. But Finland is looking attractive to me for some companies. So,
yeah.
I might
Finland,
start looking at them.
Sweden. Yeah, yeah. Really good. I think maybe someone suggested it also when we are in Malmö to give an overview of many Swedish dividend growers. So I'm really looking for that. Looking forward
Yes.
to that.
Yes.
And it will be cool, Malmö. It will be so nice.
I can't wait. The group
Yeah.
is active and lively, and I'm really looking forward to it. So let's move on to listeners'
Yeah.
questions. We're now into the podcast. So Connor has asked us, when it comes to reallocation strategies, is it better to put funds towards a relatively lower price stock where a greater volume can be acquired, or a high priced stock? It's a very
So is this about
subjective.
like let's say ASML 1,000, or buy a company that's rather trade many stock trading at 25 versus one stock at 1,000?
Yeah, to me, it looks like it's when you're looking at lower priced. It didn't say value; it said priced. So when I see that, I'm thinking, is he talking about buying a company that's, I don't know, let's say Mandatum, that is trading at 6, or is it
Yeah,
better to buy a company, let's say Siemens, that's trading at, I don't know what it's trading at now, 100 and say 50
yeah,
to 200. That's what I get from that question. But I,
yeah.
I
That that
mean,
that sorry to say, but it doesn't make a lot of sense.
it's
Yeah,
more about
yeah.
valuation. Yeah,
Yeah, it's you need to look at the fundamentals of the company, and based on that, yeah, whether you own 20 shares, let's say at $10, or two shares or $100, your stake in the company will be the same. Yeah, I think there is something to say like you have this is it Linden Sprungli, that is
yeah,
probably about, I don't know, 100,000 Swiss franc. Well, it's a pity I can't buy it. I don't have the cash for that. Yeah, here maybe in fractional shares or something like that, but generally I can buy it, which is a pity. But for the rest, should really not matter. It's more like an accessibility issue sometimes to get access to that. But I think anything below, let's say 250, must be accessible to the small investor. Yeah, everything about below 250 euros. So, and that's how I would look at it. I would not look at the share price and whether it's low or high. There's a business behind that share price, and you need to understand how much earnings or income this share price represents. So, for instance, if you buy a stock at 25 euro and there's 2.5 euro earnings behind it, you're buying it at a 10% earnings yield. That may be a good deal depending on other context. Yeah. So, and I think that's how you need to look at it. But if it's a 250 euro trading company and there's a 25 earnings per share behind it, you're talking again about a 10% earnings yield. Also context, but if you take that away and all else being equal, you get the same earnings yield out of those. So effectively, that's how I think you need to look at it.
yeah. I mean, it's a good question, right? Because I think, especially in the beginning, it's hard to disassociate yourself from price and value. You might look at someone as higher priced being a better company, and someone with a lower share price being a worse company or
Yeah,
better
but that would
value. But
also suggest that every company has an IPO at the same price, let's say at
exactly,
$1. And that's not the
exactly.
case. Some companies IPO for 100, 40, 20.
Yeah,
Yeah.
yeah. Makes sense. Fire engineer said it's Friday. It's now Saturday morning when we're recording, but it was Friday when we asked the question. He was in an airport lounge binging on Cava, so he wanted to do a more relaxed question. Okay, so which movie character do you most identify with?
Well, when I got the question, and this answer is every time different, right? Depending on the mood, whatever it is. I thought about Bill Murray from Groundhog Day, because literally this morning I was watching at my watch list. Yeah. And I have this feeling often like when you're like investing for 11 years in dividend growth investing, it becomes like this repetitive thing. And that's what they sometimes say, the boring middle, whatever it may be. Yeah. So yeah, this is now just a ritual for me. Like a few times in the week, opening up my watch list. Oh, what was on there again? Like I almost blank because I'm busy at work. So it feels like Groundhog Day sometimes. Like okay, I need to discover again what I'm going to do this day, and da 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 da. And yeah, that's what I felt like.
Nice, nice. I thought of Jason Bourne from the Bourne Identity. Just came into my head. I was thinking about, okay, what does he do? He's kind of calm, always kind of trying to think ahead, kind of like a classical long term investor mindset. He reads the field, so he's always like trying to stay ahead, trying to intercept danger. That's what we try to do with dividends. We're trying to anticipate a dividend cut ahead of time. So we're trying to spot that danger. So I'm like,
And your
Jason.
wife is always the one that he's on the run with.
Yes, exactly, exactly. Great movie. The other one that I was thinking about was Taken, Liam Neeson. I can't remember the exact quote, but I know like it goes something like, "I will look for you, I will find you, and in terms of dividends, we won't kill you, but we will buy you." So that's one I thought, but quite interesting. What's funny to know is before I lost my hair, when I used to have my beard, I was always compared to Jamie Dornan. Do you know Jamie Dornan, Northern Irish actor?
No,
I used to get,
I'm not good in names, Derek. After 5 or 6 years, I can finally remember your name.
I used to get called him quite a bit, but I'm completely different now. I have glasses, I have no hair, so I'm not like him anymore. But a long time ago, I was. Nice question, El Kuba. What are your thoughts about the last Buffett's letter as Berkshire CEO?
Oh boy,
And have
yeah,
you
I
got any
read it.
ideas about Greg Abel?
So first of all, El Kuba, thank you for asking this question because you forced me to read it. So many life lessons in there. He's effectively talking about his longevity and that it's not necessarily an easy path, and that he that is also not a normal expectation to think that you turn 95. He talks about the family's DNA. He will, by the way, I think, give Thanksgiving letters now going forward. But in the end of it, he had a really nice quote that stuck with me. He said, "One perhaps self serving observation. I'm happy to say I feel better about the second half of my life than the first. My advice, don't beat yourself up over past mistakes. Learn at least a little from them and move on. It's never too late to improve. Get the right heroes and copy them. You can start with Tom Murphy. He was the best." That's very interesting, right? Because, I'm in my 40s and sometimes you think like, shit, am I coming towards a midlife or whatever, right? And to hear that from a 95-year-old guy was a nice message. And I mean, I advise everyone that has a passion about investing, read this letter. It's like always full of wisdom, but we're talking here about the most legendary investor that ever lived, in my opinion, writing his last shareholder letter. So
Yeah, yeah, and we're alive to see that,
exactly,
which
which is
is
so
a
unique.
blessing.
Which is so unique. It's
Yeah.
it's yeah.
And what about Greg? What about Greg? What do you think he will do over the next 10 years?
I have no clue. I think they will continue doing what Buffett was doing. I think when you work with Buffett alongside it for 10, 20 years, there must be so much respect that you have the whole world looking at you. Don't screw this one up. So
Yeah,
that's the only legacy that he can have. The guy that screwed it up. So he needs to do everything to prevent that.
yeah,
That's the bar is set so high. That's just it. So, and I think he sounds boring enough to not be willing to put his name as the one that destroyed Berkshire Hathaway.
yeah. It's a tough role to win. I feel like he'll be a little bit more hands on than Buffett was, but 100%, he's going to
Well, maybe at
stick.
his age, but for
Yeah,
instance,
yeah,
will they start paying a dividend?
yeah. It's hard to know. Hard to know. I think they will. I think he will. Honestly, I think he will. But let's
Yeah, but
see.
don't hold your breath.
No.
They may outlive us.
um, Steve has said, continuing on the topic of the moment, non-resident estate taxes from the US. Are there any other territories levying such punitive taxes?
So I'm not aware of them. I'm not aware of them.
No, I don't. I don't know either. I don't know. Mr. Marksy, what are your guys' thoughts about fractional shares? Is it rational to invest this way, and would you consider to move your account to Robinhood after entering European markets?
Well, we have already fractional shares via trading 212. I think it's good that it's available. Interactive Brokers also offers it. Yeah,
Yeah,
so I think it's a really good thing for the consumers. You do get access, for instance, to ASML if it is €1,000 and you have only €100 to deploy. That's a reality for many investors in the early 20s or even later. So I think it's really what they always say so nicely, democratizing. I don't need it. What I surely want is more like direct ownership, dividend vouchers and such, and that will be a bit harder. But other than that, I'm not against it. And interactive brokers, I have the drip function turned
Yeah.
on for a few shares, and I get them in fractional, and I'm totally okay with that.
Yeah, I was just going to mention that. I think from a drip feature, it's quite useful, so you don't have to wait to have enough for a full share. Would I consider moving to Robinhood? No, I don't think so. I like
No,
interactive
especially not if
brokers.
they would lock up my account when I die.
Yeah, exactly. Okay, we have some stock related questions, and we got a question about two Finnish companies. Not two Finnish, one from Finland, one from Sweden, and the first one is Hoktamaki. I hope I said that right. Right, 100% did not, but let's go with that.
Huhtamaki.
Hoktamaki, right? Ticker symbol was on the Nasdaq is HUH1V. Um, Quite an interesting company, I would say. It's a key global player in sustainable food on the go. So basically, sustainable packaging is what they're into. The
Well,
products,
you get a chicken with feathers.
yeah, exactly. Yeah, it keeps us warm and nicer to cook. But look, I think sustainable packaging is probably like stuff that you can give to people that when they throw it in the landfill, it's not going to sit there and damage our environment. So there's definitely a space for it. I do struggle a little bit with in terms of how they can continue to make money with this over time. Because you'd imagine most packaging companies will go sustainable, but they target a dividend of around 50% of their earnings per share. They had a nice little dividend history. No dividend cut that I could see since 2008. Dividend yield of 3.62. So yeah, I mean, look like honestly look like a nice company, but I struggle with the packaging on the go and sustainable
Yeah.
solutions. To me, it's not a long term growth. I could be 100% wrong here, and I'm sure they might pivot. But we got lots of companies like that. Sunoco do it,
Yeah.
West Rock, Kappa do it in Ireland. So I don't know, but
Yeah, but there's a need. This moment in time, there's definitely a need for it. If I see
yeah, I
the
think
amount of
so.
plastic that I'm throwing away because everything is packed in plastic,
Yeah, and the amount of
sometimes it saddens me. Like, really, as society, we don't have a proper alternative solution. And then when we talk about sustainable, the issue is sustainable needs to be then straight away so much more expensive. But there are simple things we can do. Yeah, I mean, people know that I'm in oil a lot, right? Don't get mistaken. It's not that I'm against climate or a better planet. I just think it's a bit naive always, like how we look at it, and I can want to earn money from it.
yeah,
But for instance, if I go to the food market, I take either an old bag, but we have those little nets, and when I'm at the supermarket, I always and you need to weigh your own vegetables. I just put it bananas. I don't put bananas in a plastic bag and then put it on there and then put that bag in another plastic bag. No, I just don't take a plastic bag for
yeah.
the bananas, put it on there, weigh them, put them with the rest. Just saying things. There's so many little things we can do, but the only thing I feel always like, why does sustainable always need to come at a premium price? Is there no other solution? Is there really no other solution?
Is it the cost of making them? And I think that's the
Yeah,
problem.
or is the marketing? I always have a suspicion that it's the marketing as well.
I'm not sure. So from my coffee company days, I owned a coffee
Yeah,
company, and one thing we really wanted to do was to try and go with more sustainable, compostable
yeah,
cups and stuff like that. Because like we used to do offers that if people came in with their own cup, we would give them money off, right? Um, just to try and encourage that. But what we noticed, like when you're walking around, you'd see all these cups everywhere and bins. You're kind of like, oh man, it's horrible. So we did look at the
yeah,
sustainable route. It ranged in price, but you got to remember their target market for these sustainable packaging is companies with slim margins. So
yeah,
I mean, cents matter. So you're trying to
yeah.
cut down on costs. So it's hard to justify going out there. We found one in
Hmm.
Ireland locally, but when we queried why it costs so much compared to others, they were talking about it's lower in demand at the moment, so the cost per unit is higher for them to make,
Yeah, but that's
and so on.
interesting, right? So if it is if it is a volume issue, that's where I feel like governments can help.
Yes, they
Yeah,
could
by
definitely help.
giving incentives to increase the volume so that the pricing comes the same. Because I think we as people are very price sensitive.
Yeah. But I think the problem with these types of companies is that they are in this novel space now, and
Yeah,
but if they make it so cost effective and cheap and
yeah,
easy to access, it'll be easy to copy, and then other companies will roll out
Yeah,
sustainable
yeah,
packaging.
but I think it will be good for humanity.
Yes, yes. But we're talking about investments here, not humanity. That's the second company here is Bravida. Again, they're based in Sweden, I believe, but they are a Nordic provider specializing in the installation and servicing of technical systems for buildings and facilities. So, like your air conditioning, your plumbing, your heating, your ventilation, sprinkler systems, so on, so on, so on. So immediately I saw that, I was like, "Oh, okay." In my area of competence, they look like a company I'd like to look at. I just looked at some of their recent quarterly results, and their order intake has been growing year over year. This year it grew 5%, and net profit jumped maybe up to 22.5%. So it's been growing quite nicely over the last 5 or 10 years, I would say. Revenue has been dipping though, so the market seems a lot softer in the Nordics. I'm not close to that area, so I don't know. But from looking at it, it looks like revenue is kind of flatlining and even declining slightly. Um, so something to look at. But when I look at some analysts, and I know we don't pay much heed to them, but they know that market better than me. They do talk about a softer market, but it also shows how well the business is holding up, given the softer market, showing that their net profit is still jumping, and even their order
Yeah.
backlog is starting to grow. So it looks like a well-managed company from the outside. Their dividend policy is to pay out more than 50% of net earnings, which is also good. And I could see no dividend cuts on their website since 2016. So, I mean,
Wow.
steady growth. Very little debt, 50% debt to equity ratio. I mean, looks like a really nice company, I would say. Similar to AOS Smith, if you're looking for a US
Hmm.
alternative. But again, it's from Sweden. The dividend tax is higher, so I would probably stick to more US or Western European companies. But yeah, I think it's two nice companies. Christian, what do you currently think about Hornbach and the two US giants, Lowe's and Home Depot?
Yeah, I mean, we're now already at the 1 hour 20 minutes of the recording, approximately. So, generally speaking, for me, Home Depot is the best. Yeah, it's very impressive how the leadership there has built and grown this company. I like how they are also, but it's for all three of them. They're all now focused more also on the professional builder. Yeah, not only anymore the do-it-yourselfer. How I look at it, I think Lowe's may be interesting now from a valuation point of view. The share price hasn't really gone anywhere in the last 4 years. It's still trading at the same price. I think Hornbach, of course, top notch, but I would like to see it a little bit lower. And then you have, Home Depot, and then you have Hornbach. I think is like a good European alternative. Don't expect too much growth, but expect a lot of stability and reliability. So that's how I look at them.
Yeah. We might finish up then with one last question. We have a couple we might move to next week.
Yeah.
And Martin has asked us our thoughts on Valmet. It's a Finnish engineering and manufacturing company. Any thoughts?
Yeah, I like looking into it actually. Again, a company with its roots going back to the 1800s. It's crazy, right? But this company is a global developer and supplier of process technologies, automation, and services for the pulp, paper, and energy industries. So you're probably very familiar again with the kind of equipment they have. So they have these automation systems and flow control solutions here. Without going now into do a deep dive or something like that, I just find it very interesting that the dividend has grown from 2013, when it was 15 euro cents per share, to 1 euro 35 now. That's almost a tenfold. That's crazy. Yeah. Dividend policy is to pay 50% of profits. What is interesting is that they just generally have a high payout ratio, although it's 50%, because for instance, they paid 89% of their earnings in dividends in 2024. And if it says 50%, it has not done that since 2013. It has always been above it, which makes it very interesting. The yield currently is 4.9%. So, yeah, interesting company to study a little bit more. Maybe I'm considering maybe a dividend stock card. But I think with the other two Finnish companies that you were talking about today, as well, I think there's so much opportunity to double down a little bit on expanding our stock database with some Nordic stocks here.
Yeah, I think so. And yeah, it definitely looks like an interesting company. You spoke about the automation systems. I'm broadly familiar with DCS and flow control systems, so it's one I would like to look into a little bit deeper. Payout ratio does concern me, I have to say, but like you said, it's been high for a long time, and they've grown at 10%.
But Martijn reached out, so I took it as a question on the podcast. But this one deserves a bit of a different, deeper look. Maybe they just have a very strong balance sheet and pay it always out of cash flow, and they don't need to reinvest a lot in the business. So, yeah, let's see.
Okay, nice one. Some nice companies there. Some more to look into in a little bit more detail. But I think the Nordic region is definitely one that's interesting me at the moment. Lots of good growth. We spoke about their economies and stuff, so quite nice.
Yeah, we'll take the questions from Tim Ainley and Fabian separately. Yeah,
yes, we will.
Probably next show.
We'll do the next show. As always, thanks a million for listening. If you stuck around for the full 1 hour and 26 minutes, thank you so much. We do appreciate it, and we will see you all next week.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.